Today, I will be discussing individual savings accounts. I will cover cash ISA, stocks and shares ISA, lifetime ISA, and the innovative finance ISA. But just to clarify before I move any further, I am not a financial advisor. It is advised and important for you to do your own research to determine your own comfortability and risk threshold. If you're new here, hi, I'm Vern and welcome to my channel. I plan to share my experiences and journey with online entrepreneurship and where and how I invest whilst I try and figure out a way to make passive income, to share my experience, all my successful experiences and all my failed experiences as best as I possibly can, whilst still trying to run a full-time job, while naturally trying to combine it with my passion for content creating. And since I'm one of those people, I thought I'd start exploring the different ways to make money online, the different kinds of ways to invest. And besides, this whole YouTube thing has been long overdue. Let's get right into it. An individual savings account is a type of savings account that is offered in the United Kingdom. ISAs are designed to encourage people to save and invest by providing a tax-efficient way to save money. The total amount of money you can save in an individual savings account in the current tax year is £20,000. This is the maximum amount of money you can contribute to an ISA in each tax year. This is known as your annual ISA allowance. ISAs are sometimes referred to as tax wrappers because the money you hold in them is sheltered from both income tax and capital gains tax. Tax wrapper is basically a wall around your ISA, which means no matter how big your investments get, the tax man won't be able to tax them. So if you come to withdraw your money or your income, or you sell those investments at any point, you will not pay a penny in tax on those. One of the main benefits of an ISA is that any interest or returns you make on your savings are completely tax-free. This means that you get to keep more of your money and can potentially earn a higher return on your investments than what you would on a standard savings account. Another benefit of an ISA is that they are flexible, which means you can withdraw your money from your ISA at any time. However, for one, you should be aware of your stocks and shares ISA, that if you withdraw money from your stocks and shares ISA, you may be subject to market fluctuations and may not get back the full amount you invested. So just keep an eye out for that. So just a quick summary on that. ISAs are a tax-efficient way to save or invest money in the UK. They offer a range of benefits, including tax-free interest and returns, a flexible approach to withdrawals, and an annual allowance of up to £20,000. My best advice is that if you're interested in opening an ISA, make sure to do your research and find the one that best suits your needs and investment goals. Putting your money aside into an ISA to protect it from tax is, in my opinion, a necessary move in today's uncertain times. With that being said, let's look at investments that aren't protected in an investment portfolio and the effect that taxes have on them. As a lower rate taxpayer, you're entitled to receive £1,000 of interest per year from cash, tax-free, and anything above that will be taxed at your normal tax rate. This is 20%. So for every £100 in interest that you receive above your £1,000 allowance, you will lose £20 of it to the government. As a higher rate taxpayer, you get £500 allowance and then you're taxed at 40%. An additional tax rate payer, you're entitled to no tax-free allowance on interest, and you will be taxed a massive 45% of anything that you receive from cash. So if you receive £100 in interest, you get taxed £45 of it. Now, if you look at shares, there's two types of taxes applied to shares. Firstly, capital gains. This is tax on any profit that you receive when you sell an investment. And secondly, dividend tax, the type of income that you receive from your shares. Capital gains tax allows every individual in the UK to earn £12,300 tax-free on capital gains per year. Lower rate taxpayers will pay a tax of 10% on capital gains above the £12,300, and higher rate taxpayers will pay 20%. But then in regard to taxes on dividends, you're entitled to £2,000 a year tax-free dividend, and the tax rate on anything above that £2,000 goes from 7.5% up to a ridiculous amount of 38.1%. If you invested £100 a month into the FTSE 100 tracker and got an average return of, let's go with 9%, plus adjusted your investment contribution every year with an extra 2% to account for inflation, and you committed to doing that for 30 years, you would have invested close to £49,000, but the value of your investment investment would be over £200,000 in total. Despite getting £12,300 worth of tax-free capital gains, if you were to sell your pot, you will be paying a chunk of this in tax, around £16,000 to £32,000. This is just a rough number, but if you had these protected in an ISA and you were to sell these funds, you will not pay any tax on it. With that being said, let's look at some of the type of ISAs available to us. The cash ISA. A cash ISA is a savings account where you can save money tax-free. It works the same way as a regular savings account, but the interest you earn is not subject to any income tax. This ISA is specifically for holding cash, and you have to be 16 or over to use one of these ISAs. You don't pay any tax on any interest you receive on the cash that's deposited within the cash ISA. There are, however, 4 or so different types of cash ISAs, I believe, but I won't be going into them today, unless you request one for a future video. Pretty much all you need to know is that it's long term, which focuses on the longer you invest these funds within a cash ISA, the higher your interest rate you receive will be. On a different perspective, the ability to withdraw money from a cash ISA ranges from an instant access ISA, meaning you could take out money whenever you like, to a fixed term ISA where you lock away money for up to 5, 10 or 15 years. What you need to decide as a potential investor in regards to the cash ISA is, with this money that I'm going to put into my cash ISA, will I need to have instant access to it? And if not, how long a time frame am I looking to lock away these funds? Because the longer the time frame that you lock away the money, the higher the interest rate you receive. That's in a nutshell. Cash ISAs typically provide a higher interest rate than your normal bank account, but I personally do not see cash ISAs as a way to build long-term wealth. I would just use it to store funds in the medium term, funds that I do not generally need access to right now or anytime soon. The restrictions are perfect if I struggle to save money, because I have no self-control and I remove money from my personal savings account or exceed my budget for non-essentials and materialistic habits. You could choose the period on how long you want to lock away your money, but these restrictions and requirements on when you could take out your money and how much you need to contribute each month in order to qualify for the interest rate varies from provider to provider. So do your own research. You could also speak to your bank about cash ISAs. Number 2, the stocks and shares ISA. As I've mentioned before, the tax wrapper incentive. You pay no tax on any income that you receive in the form of dividends. And if you sell your shares, you pay no capital gains tax. The top points are, the maximum contribution per year is £20,000. You need to be 18 or over in order to have a stocks and shares ISA. You can only contribute to one type of stocks and shares ISA each year with one provider. The name suggests that these are just for shares. You can actually hold a few different types of investments within this ISA, including stock, shares, ETFs, funds, unit trusts, government bonds, and corporate bonds. The reason why the stocks and shares ISA is so good for building wealth is that the stock market has provided a higher return than leaving your cash in the bank. The average rate of return on the FTSE 100 is around 9%, which means the compounding effect of your funds within this type of ISA is significantly higher than it would be if you were to store it in cash. If I were to go back in time and give myself advice, it would be to opening a stocks and shares ISA. I wish I did years ago. The earlier the better, even if I were to make small contributions to it. I'm very aware that a higher rate of return is also a higher rate of risk, but I'm willing to chance that risk because I believe investing on the long term, 10, 20 years, could rectify some of that risk throughout the ups and downs. I am not assuming that the returns are guaranteed, even though it has averaged a 9% return for the last couple of decades. It might not necessarily mean that it's always going to be like that going forward. Do your own research and only commit money that you are willing to possibly lose in case things go south, and only invest for the long term. Most banks provide their own versions of the stocks and shares ISA, but I would also consider other specialist providers such as Hargreaves Lansdown and Vanguard. My primary focus when I look around for a stocks and shares ISA is to make sure that the management fees that I'll be paying are low. Vanguard is one such platform. The management fees are low. The management of a stocks and shares ISA through Vanguard is less than 0.5% of the total value of the pot each year. There are contribution limits across the different ISA types. Allow me to try and simplify it. Here are 20 bananas, each representing £1,000. And together they represent the total amount that you can contribute to a UK ISA in each tax year. We have an innovative finance ISA, a lifetime ISA, stocks and shares ISA, and a cash ISA. Remember, the lifetime ISA has a maximum contribution limit of £4,000. You will not get the tax benefit on top of it if you end up contributing more than £4,000. Never put in more than that. You may contribute to the other types of ISAs as you wish. For example, You might want to put £7,000 into the Innovative Finance ISA, £3,000 into the Cash ISA, and £6,000 into a Stocks and Shares ISA. Or you could just contribute all £20,000 into a Stocks and Shares ISA, or only use £1,000 out of that £20,000 tax-free allowance. £20,000 is a limit, it's not a target. Your annual ISA allowance expires at the end of each tax year, and any unused allowance will be lost. It can't be rolled over the following year. There are rules around making contributions to two of the same type of ISA within the same tax year. If I contributed £1,000 into a cash ISA in 2022, and I am not happy with the provider, I would have to wait for the next year and the new financial year to open a new cash ISA with another provider. You could have more than one cash ISA with different providers, but you cannot contribute to two cash ISAs within the same financial year. This rule applies to all types of ISAs. You can only contribute to one type of ISA within a financial year with one financial provider with the limit of £20,000, which could obviously, as I've mentioned, be spread across the different ISAs as you see fit. Just remember, with the lifetime ISA, it has a limit of £4,000. You can make a lump sum investment and or regular contributions throughout the tax year. Any increase in value of the investments in your Stocks and Shares ISA is free of capital gains tax, meaning they do not add to your allowance. Any investment growth or investment earned within a Stocks and Shares ISA is tax-free, hence tax wrapper. Think of it as a great wall protecting your interests from the taxman. There are lots of different types of investments that can be held within an ISA, such as unit trusts, investment trusts, exchange traded funds, individual stocks and shares, corporate and government bonds, open-ended investment companies, OEICs. I got independent financial advice from a regulated financial advisor before I really got into anything. It is important for you to know that financial advisors are regulated by the Financial Conduct Authority. A Stocks and Shares ISA could be for you if you're happy to put your money into investment funds for long-term savings with tax-free growth. You aren't looking for immediate access to your money and are prepared to keep your money invested for a number of years. What I mean is, you're in it for the long haul, and you're comfortable with the fact that the value of your investments can fluctuate, meaning it can go both up and down, and you might get back less than what you invested initially. The Lifetime ISA. Let's call it a LISA. This type of ISA is different from the others, and it is mostly for young people to save for retirement, or ideal for young people. This ISA requires you to be over 18 in order to use this, but you also have to be under the age of 40, so 18 to 39. So you can't pay into it past the age of 50. As I've mentioned before, it has a maximum contribution limit of £4,000 a year, but the government will top up whatever you put in up to that limit of £4,000 by 25%. So basically, if you put £4,000 in, the government will top it up by an extra £1,000. You don't have to top up to the maximum of £4,000. You could also just top it up with £1,000 if you like. You will still receive that 25% top up from the government, which means in this instance, you will get an extra £250 on top of that £1,000 investment. Very nice. You could use the money that sits within the ISA to invest in stocks and shares. There are some circumstances you need to be aware of with this ISA. You can't access these funds until you're 60, unless if you're buying your first home. The rules that apply to this exception are that your ISA has to be open for at least 12 months and the property, I believe, costs less than £450,000. You have to be buying the property with a mortgage. Also, you have to use a solicitor in order to purchase the property, as the funds will be paid directly to them. And if you have unfortunately been diagnosed with terminal illness with less than 12 months to live. With that in mind, if you withdraw your funds from your LISA for any reason apart from what I've just mentioned, you will pay a withdrawal fee of what I believe is 25%. You could use this to help you buy a house, or just use it to make extra guaranteed money for later in life. The LISA isn't bad at all, but the lack of flexibility to access my funds are not ideal for me. And I guess it makes it a bit of a negative, but not entirely a deal breaker. I can easily see it as a different type of pension, and it may or may not be better than a private pension. There are different situations where, if you compare it to a private pension, you can withdraw from the age of 55, but when you come to withdraw from your private pension, you get taxed at your current tax rate, so anything between 20 and 45%. But with the Lifetime ISA, you get an extra 25% top up from the government. And when you withdraw the funds at the age of 60, they are completely tax-free. The ability to withdraw the money at the end, completely tax-free, is just a bonus for me. The innovative finance ISA. You have to be over 18 to have one, and there's a maximum contribution of £20,000 a year, split across the other ISAs, of course. You have instant access to take out your money as you like. The key point of this ISA is specifically for investing with peer-to-peer lending. It is also a tax wrapper, so that means any gains on those investments are not taxed at any point. To roughly break down what peer-to-peer lending is, well, it's a form of lending whereby an individual such as yourself lends to other businesses, lends to another business or individual, replacing the need for a bank. The investments you can hold within this type of ISA include peer-to-peer lending, crowdfunding, and lastly, cash. Peer-to-peer lending, in my opinion, is more risk, and it does not have a long history compared to the stocks and shares ISA because it is relatively new to the industry, and also some of the rates on peer-to-peer lending are high. So again, please do your own research and look into these things with detail. If you wish to switch to your current or previous year's ISA to a different provider's ISA while simultaneously keeping your future tax benefits intact, you have to arrange for a transfer rather than selling and reinvesting. If you do simply close one ISA and open another, you lose those tax advantages. All ISA providers have to allow transfers out, but they don't necessarily have to allow transfers in. You can transfer money from a cash ISA to a stocks and shares ISA and vice versa. If you transfer an ISA that you have paid into during the current tax year to a new provider, you must transfer the whole balance, I believe. For ISAs from previous years, you can choose how much you want to transfer. The good thing is, if a fund manager goes bust and owes you money, and the manager is covered by the Financial Services Compensation Scheme, you can claim compensation of up to £85,000 per person, per institution, but you won't get any compensation just because the value of your investments dropped. If you're unhappy with the service you receive or would like to make a complaint, start off by contacting your provider or your advisor. Most fund managers and ISA managers are regulated by the Financial Conduct Authority. This means that if your complaint is not resolved to your satisfaction, you can then take it to the Financial Ombudsman Service. So just to summarize what ISAs I've covered so far. Cash ISAs. This type of ISA is similar to a regular savings account, but the interest earned on the account is tax-free. Cash ISAs can either be instant access or fixed term, which means you need to leave your money in the account for a specified period to earn a higher interest rate. Stocks and shares ISAs. These ISAs allow you to invest in shares, investment funds, and other types of assets. You can choose from a range of investment options to suit your risk tolerance and financial goals. Any interest you earn from your investments within the ISA are tax-free. Innovative finance ISAs. This type of ISA allows you to invest in peer-to-peer lending platforms, which connect borrowers and lenders directly. Lifetime ISAs. This type of ISA is designed for people who are saving for their first home or for retirement. You can save up to £4,000 per year in a lifetime ISA, and the government will add a 25% bonus on top of your savings, up to the maximum of £1,000 per year. The bonus is available until you reach the age of 50, after which you can withdraw your savings tax-free. And one which I haven't mentioned, junior ISAs. These ISAs are designed for children under the age of 18, and they can be opened by parents or legal guardians. You can save up to £9,000 a year in a junior ISA, and the returns earned on the savings are tax-free. Your ISA allowance is how much you pay in, not the total value of your investments. So if you put your whole allowance in a stocks and shares ISA and it falls in value, you can't top it up in the same tax year. ISAs provide a tax-efficient way to save and invest for various financial goals, and there are several types of ISAs available to suit different needs. It is essential to understand the features and benefits of each type of ISA that you are interested in before opening an account, and seek professional advice if necessary. I understand this was a rough breakdown of the different types of ISAs, but investing is actually quite simple, and it isn't as complicated as the movies make it out to be. I genuinely do hope you found this video helpful. Please do let me know if you have any questions in the comment section below. I'll try my best to reply to each and every comment as best as I possibly can. Please support this channel by hitting that subscribe button and smashing that like button. With that being said, that's it for this video, and I'll catch you on the next one.